Unlock the key to successful mutual fund investing by mastering risk analysis with our expert insights today. Risk analysis for successful mutual fund investing. Risk analysis is a critical component of successful investing in mutual funds. It helps you understand the potential risks associated with your investments and allows you to make informed decisions. Here's a step-by-step guide to conducting risk analysis as a mutual fund investor. Understand your risk tolerance. Assess your financial goals. Determine your investment objectives, e.g., retirement, buying a house, education, and the time horizon for achieving them. Evaluate your risk appetite. Ask yourself how much volatility you can tolerate. Are you comfortable with short-term losses for long-term gains, or do you prefer stable, low-risk returns? Consider your age and financial situation. Younger investors with a longer time horizon can typically afford to take more risks, while those nearing retirement may prefer safer investments. Understand the types of risks in mutual funds. Market risk, the risk of losses due to market fluctuations. Credit risk, the risk of default by issuers of bonds or debt instruments held by the fund. Interest rate risk, the risk of bond prices falling due to rising interest rates. Liquidity risk, the risk of not being able to sell your mutual fund units quickly at a fair price. Inflation risk, the risk that inflation will erode the purchasing power of your returns. Concentration risk, the risk of overexposure to a specific sector, asset class, or region. Managerial risk, the risk of poor decision making by the fund manager. Analyze the mutual fund's risk profile. Fund category. Different types of mutual funds carry different levels of risk. For example, equity funds are riskier than debt funds. Sectoral or thematic funds are riskier than diversified equity funds. International funds carry currency risk in addition to market risk. Historical performance. Analyze the fund's past performance during different market conditions, bull markets, bear markets, and periods of high volatility. Standard deviation, a measure of how much the fund's returns fluctuate over time. Higher standard deviation indicates higher risk. Beta measures the fund's sensitivity to market movements. A beta greater than 1 means the fund is more volatile than the market. Sharpe ratio measures risk-adjusted returns. A higher Sharpe ratio indicates better returns for the level of risk taken. Expense ratio. High expense ratios can eat into your returns, increasing the risk of underperformance. Diversify your portfolio. Spread your investments across different asset classes, equity, debt, gold, etc., sectors and geographies to reduce concentration risk. Use a mix of mutual funds, e.g., large cap, mid cap, small cap, hybrid, and debt funds to balance risk and return. Monitor economic and market conditions. Stay informed about macroeconomic factors, e.g., interest rates, inflation, GDP growth, that can impact mutual fund performance. Keep an eye on geopolitical events, regulatory changes, and industry trends. Review the fund manager's track record. Evaluate the fund manager's experience, investment philosophy, and past performance. Check if the fund manager has consistently outperformed the benchmark index over the long term. Use risk management tools. Systematic investment plan, SIP. Invest a fixed amount regularly to average out market volatility. Stop loss orders. Set a threshold for selling your mutual fund units if the value drops below a certain level. Asset allocation. Rebalance your portfolio periodically to maintain your desired risk level. Regularly review your portfolio. Monitor your mutual fund investments periodically, e.g., quarterly or annually, to ensure they align with your risk tolerance and financial goals. Exit underperforming funds or those that no longer match your risk profile. Seek professional advice. Consult a financial advisor to help you assess your risk tolerance and build a diversified mutual fund portfolio. Use tools like risk assessment questionnaires provided by mutual fund companies or financial platforms. Stay disciplined and patient. Avoid making impulsive decisions based on short-term market movements. Stick to your investment plan and focus on long-term goals. By conducting thorough risk analysis and adopting a disciplined approach, you can increase your chances of success as a mutual fund investor. Remember, all investments carry some level of risk, so it's essential to balance risk and reward according to your financial goals and risk tolerance.